Hey everyone, it's Nick Jerusalem here with the Jerusalem's Happy Home team, wrapping up our quick little video series about tax consequences when selling a home. Our previous two videos, we had chatted about what happens if you're selling your primary residence, both right away within a 2-year or less period, or maybe you've owned the home for a long period of time. So the last part is what happens if you're selling a property that isn't your primary residence. It's an investment, it's a rental property. What are the tax implications look like in those circumstances?
Well, there's two things to think about here, Nick. One is, let's say it was always a rental property, you never lived in it.
Okay.
And then the second one we'll talk about is you once lived in it.
Okay.
Okay? So always a rental property, you never lived in it. It's an investment property.
Mm-hmm.
Okay? If you own it for over 12 months, it's capital gains when you sell it. Okay. If you've been using it as a rental, you are required to take depreciation recapture. Now, what's important about that is even if you actually didn't depreciate it, if you were doing your own taxes, you didn't understand what depreciation meant, and you never depreciated it, the rules say that you still have to recapture what you should have done.
Okay.
So it's one of those situations where if you do have rental property and you're doing your own tax return, be sure you're doing it correctly.
Okay.
Okay? So again, when you sell that rental property, we look towards basis, okay? Basis is what you purchased the property for, plus any improvements you made on the property.
Okay.
Okay? Then after that, we take depreciation recapture and we subtract that from basis.
Okay.
Okay? So let's say you purchased the property for $300,000, okay? Improvements of $100,000.
Mm-hmm.
So our basis now is 300 plus 100, 400,
Mm-hmm.
but you depreciated it over the years, and that happened to be an even number of 50,000.
Yeah.
I made up that number.
Yeah,
It
that's
might
very
not be.
convenient. It's
Yes,
nice,
I know.
yeah.
Okay, so you take that 400 and subtract the 50.
Mm-hmm.
Okay, so now we're at 350
Okay.
for our basis, right? We sell the property for 500,000, so we have a gain of 500 minus the 150, which is the 350. Which is 150,000.
Mm-hmm.
Okay.
Okay.
We also get to subtract the closing costs.
Okay.
Okay.
All the sales cost, yeah.
Cost of sale. Let's say that was 50,000. So now you're looking at gain of 100,000.
Okay.
Okay. That gain is taxed at, generally speaking, capital gains rates. Again, you have the 12-month holding period in order to be at capital gains rates, but there's also a piece of depreciation recapture that's going to be taxed at your ordinary income rate.
Okay.
Okay.
So the depreciation recapture will be taxed at what your ordinary income rate is. The remaining gains will be taxed at whatever the capital gains rate is for your specific tax bracket.
Yep.
And that's if you've owned the property for at least a year or more, or
Yep.
is that okay? So now if I bought a property, let's say we fix it up and we sell it in 6 months after we bought it, what does the tax consequences look like in that circumstance?
Then you don't get the capital gains rate.
Okay.
So
then it's
it's
taxed at
ordinary,
whatever your income is.
whatever your ordinary income rate is.
Okay, got it. Perfect. So if you have any more specific questions on tax consequences for selling investment properties, feel free to call, text, or email. Visit us online at happyhometeam.com and we can help you get those questions answered.
Absolutely. I want to add one thing that
Yeah.
we didn't talk about. Be careful when you're trying to estimate what your taxes are going to be, because we tend to estimate too low, meaning that we just say, okay, I'm going to pay 15% capital gains on $200,000. So that's $30,000. So after I sell my property, because you've already figured out all the math, you figure out your gain is $200,000 in a 15% bracket, and you say, I need to put aside $30,000. That is not enough to put aside. And that is because whatever that capital gain is, it increases your tax bracket.
Right.
Okay? And so your other income might have jumped up a tax bracket.
Okay.
And so you might not be limited to literally 15% of what you think your capital gain is. And that's a common error, and people get a surprise when it's time to do their tax return.
Got it. Yeah.
Okay?
They're not taking in kind of the final income picture into effect. They're just looking at just
Yes.
the house and the sale, not how does that relate to my income as a whole.
Yes.
Got it.
Yes.
No, great point.
Yep.
So as you can see, things can be complicated, and so it's always good to have a very smart and well-trained and experienced accountant as we do. So again, thanks for tuning in, and look forward to helping any way we can.